Welcome to the Stage Analysis Weekend video. It's Sunday the 8th of January 2023. So we're going to go through a fairly large amount of things today. I want to start off with a focus on the major US sectors though, as we haven't covered that for a little while. Before getting into the indexes, industry groups, the industry group bell curve, regular market breadth charts, and finishing off with the watch list stocks at the moment. So as the midweek video was a little bit earlier this week because of the shortened week, and I did a focus on the oil and gas stocks. So as they were in stage 3 and some early stage 4 breakdown attempts. So it was a little bit different than the midweek video this week. So I'll cover some of the earlier in the week watch list stocks as well, which was more focused around the gold miners at the time. So do that right at the end of the video. But starting off, as I said, getting into the major US sectors here. Industrials is a big feature this week with the watch list stocks in the weekend scans. It was around a third of the watch list stocks from the weekend scans. With the actual sector itself, this is the XLI. So this covers the major S&P 500 sectors, so it's not the entire market, it's only the S&P 500 groups, but it does give a good proxy of what's going on in the market generally, but it's not always perfect. You'll note with the XLV, which covers the healthcare, it's very different to what you see in the actual healthcare group otherwise if you look at the more broad market measure. But in this case, XLI attempted to break out into stage 2 a little while ago now, a couple of months ago here, and has rolled back over and pulled back through the level again. So potentially an early stage 2, currently leading in terms of relative strength other than energy, which has been the RS leader over the last year, but starting to tail off now. In terms of the stage analysis technical attribute score on this, if we change the chart structure to the stage analysis technical attributes, which is the SATA score. So this has 3 different versions of the indicator here. The coloured bands at the top, the red being when it's below 3, the blue when it's between 4 and 6, and the green when it's 7 and above. So basically it's technically stronger when it's green and it's technically weaker when it's red, so i.e. potentially in the stage 2 zone, potentially in the stage 4 zone. But it's not perfect, so it gives you just a rough idea of what's going on with the technical attributes of the stock, and whether it's in a good position to potentially move into stage 2 or not if it hasn't yet broken out at that time. So currently we're testing that stage 2 level in the industrials here. You can see it's got a SATA score of an 8. If we flick through into here and have a look at it in stock charts are a little bit cleaner than trading view for this purposes. You can see the relative strength breaking up to new highs here. Again, you can see the test of the stage 1 range here. So started to move into potential stage 1 here, rolled over as we often see at the start of stage 1 very quickly and pushed back towards the lower end of the range, and actually had a failed stage 4 continuation breakdown to the lower side, and then continued building that stage 1 structure. So the early stage 2 breakout attempt formed as an up thrust and came back in again, and now it's attempting to move out again. So potentially an early stage 2 with this one, see breaking back through the original structure here where it broke down into stage 4 back in, what were we there, April time last year. If we look at some of the other groups at the moment moving, so materials is also showing decent strength in the near term here. We had a good week on that, also testing up towards the stage 2 breakout level. Another one that had a early stage 2 attempt but came back into the range again. So consider it still in stage 1 at the moment, but obviously pushing and testing that level. Communication services is one of the weakest in the group. It did have the biggest move this week overall. If we look at the overall relative strength table here, you can see this is ordered by using stock charts SCTR score. It's this area here, and it shows you the energy has got the highest SCTR score, which basically uses a measurement of long, medium and short-term measures. So energy has been the leader for a while, but it has been starting to tail off now, obviously with stage 3 behavior in energy at the moment. If we look at that individually, you can see the stage 3 range that's developing. the up thrust behaviour back here, and it still hasn't managed this significant reversal bar that it had just over a month ago. Hasn't been able to get back above that or its 10-week moving average there. So if it does start to roll over, come back below that 30-week moving average, then potentially we could start to see a break to the downside into stage 4. But at the moment, this is tailing off in stage 3, while the rest of the industry groups are obviously doing the opposite. They're moving up through stage 1 bases into some early stage 2 attempts. Get back to the charts here. See, communication services, as I said, is the laggard. See right at the bottom of the group here. So it's only got a 12.2 SCTR score at the moment, which is really weak. Everything below the S&P 500 score here. So this is your S&P 500. This is your baseline. So what we call the zero line as such. So everything compares to that. So you want to be focused in the groups that are improving above that, not the ones that are declining above. And you want to, in any below that are improving, you want to wait until they start overtaking the S&P 500, breaking through the zero line. So at the moment, communication services is still weak, technology is still weak, consumer discretionary is still weak, and real estate is still weak there. So get back to the group. So this one's just starting to have a change of behavior in the short term here. Potential early stage 1 base structure starting to develop in the communication services. Energy, as I said, breaking in stage 3 at the moment, so looking for that to continue to weaken and roll over, and this potentially would then be an up thrust after distribution, maybe a last point of supply, lower high test, and it could roll. So if it does, on the other hand, start to break above this significant bar again, then that would nullify that potential, and we could see a stage 2 continuation. But at the moment, treating this as a weakening in stage 3. Financials also testing the stage 2 level here. See this zone, it's been tested multiple times over the course of the last 8 or 9 months or so. Had an early stage 2 breakout attempt that failed back in October, November time there to come back in, tested the 30-week moving average, and has rebounded back up to the level again. So potential for stage 2 breakout attempt if we can get a strong move, ideally better than average volume on it. Don't always get that with sector charts. So not necessarily something that's a requirement on a breakout, more so it's a requirement on the smaller and the mid-cap stocks. You don't generally get it with the large cap stocks or with any kind of ETFs really. So we'll do XLF. XLI we already covered. Technology continuing to develop in potential stage 1 here. So it has the recent move up. It's pulled back in around % of that at the moment. So you can see here, testing the lower end of the range again, starting to pull back up. If it can start to get back above this 30-week moving average and the near-term pivot, might take a few weeks or so to do that, then potentially could start to move into early stage 2 as that 30-week moving average would start turning up and the 10-week would start crossing back above there. So although it would still obviously have a big zone of near-term resistance to deal with if it did do that. Consumer staples, another one of the stronger areas of the market recently. You can see big move up it had through September into November. It's been consolidating in a very tight range here. So looking for a stage 2 continuation attempt in this one. Real estate, developing potential stage 1. So the initial move here failed, rolled over, made a stage 4 continuation to new lows. Hadn't yet got back up to that 30-week moving average and rolling back over. So there's potential that it could be moving into stage 1 here, but it's still got more to prove. So still class this one as a stage 4 / early stage 1 at best. So real estate continues to be weak. Stage 1 developing in utilities, failed stage 4 continuation to new lows and reverse back up to the 30-week moving average. See the 10 and the 30 are just starting to cross back over again. So this one's obviously in a sideways range here. Healthcare broke out into stage 2 of the S&P 500 healthcare stocks back in, what were we at? In November, early November, and has been consolidating in what we call the backup range here. So looking for a continuation move higher in here. So as I said, this is only the S&P 500 stocks. So healthcare looks very different if you look at it from a broader market perspective. It's actually one of the weakest groups. So obviously in the S&P 500, it's one of the stronger areas. So different types of stocks. So you need to drill into the groups a bit and actually know what you're trading. There's just saying healthcare is strong, then trading any old small mid-cap stock from the healthcare group is not necessarily going to get you the same result, as that's not what this is showing. This is very focused on the large cap stocks in the group that are in the S&P 500. So know I think it was 64 or so stocks in the XLV. So know which stocks are actually in it, and so you're not actually trading something that's not in it if you are looking at this from a relative strength perspective. And then the XLY been the weakest of the groups. Starting to see a little bit of a change in that in terms of the actual watch list, etc. But in terms of the S&P 500 group stocks in the XLY, it is the weakest at the moment. It's obviously heavily dragged down by some of those mega cap stocks, such as the Amazons, etc. So at the moment, this one's testing the bottom of the range, a little bit of a terminal shakeout. So looking for some spring type action back into the range. If it does, for a quick sharp move back through that 30-week moving average, and then a hold and rebound up. So, but again, this is the weakest area of the sectors at the moment. Right, let's move on to the indexes next. Okay, next up is the indexes. So I'm going to start, as always, by looking at the S&P 500. So this is the key index that we track, and we obviously compare all of our stocks with when we're looking for the Mansfield Relative Strength Rating. So it's the most important index to actually focus on from a stage analysis perspective, as it's our universal area to compare against. So Friday we had what the CanSlim followers like to call a follow-through day. Let's see, big move. I think this was potentially day one or day one. One of these two was day one back here in terms of their follow-through day method from the how to make money in stocks. So we've had a couple of other follow-through days that have been undercut more recently. It doesn't mean this is the original follow-through day. And so this one still, and the low of this hasn't yet been undercut. So the original confirmed uptrend IBD status has been reinstated with this move back up through here, but we didn't actually close back above the 50-day moving average, so much more of a weaker follow-through day attempt at the moment. Hasn't yet cleared this range convincingly, but we did see some market breadth positives in terms of the short-term breadth. We saw percentage of stocks above their 20-day EMAs move back above the 70% level. We saw the bullish percent index intraday charts start to, with many point-of-figure breakouts, when it started to gap up above its short-term moving averages there. So there was some other positive developments in some of the short-term breadth. So potentially it is a change to a more positive environment in the short term, but there is obviously still on a very neutral rating in terms of more medium and longer term measures. You can see that the stage one base still intact here at the moment. We're still very much right in the middle of the range here. So the majority of the price action, there's been no obviously overriding area where it's formed. It's pretty much all through this area. So currently we're right in the middle, looking for this to continue up towards the 200-day moving average. If we compare against the weekly chart here, you can see just closed underneath the 30-week moving average. 10-week moving average is above the 30-week at the moment. So looking for this to continue to improve, start to push out of the range here, potentially start to get up and out. If it can get through there, we potentially could have a stage 2 breakout attempt at that point. No guarantee of that low. You can see we're still in this major downtrend channel that it's been in, obviously, over the course of the last year. So nothing's changed really, other than we've been going sideways since May last year. So more than got seven or 8 months now of sideways trading. And if we look at the S&P equal weight low, we can see there is a little bit of a difference here. So if I flick between the two of these, you can see that the S&P 500 regular has been underperforming compared to the equal weight chart. So I've highlighted this a few times in the Twitter feed. Friday's move, or this week's move, pushed the bar back out of the recent range here. We're above the 30-week moving average and moved back above the rising 10-week moving average here. So this one's in a much stronger position than the actual S&P 500 itself. It could actually make a stage 2 breakout attempt as early as the next week, based on obviously the bar sizes from during in the range. So there is a chance we could test the upper part of the range, but if we go back to the S&P 500 regular, then that probably wouldn't be testing the stage 2 breakout level at the same time. So there was a little bit of a divergence in there in that regard. And if we look at I also posted the percentage of stocks in the S&P 500 on the Twitter feed on Friday for the 200-day, 150, 50-day, and 20 days. So the combined score of all of those, if you calculate it together, was 66.25% of stocks are actually above their short, medium, and long-term moving averages in the S&P 500. So we've got 2/3 of stocks above their obviously short, medium, and long-term moving averages. So we are in a positive environment in that regard currently, and so we're within potential stage 1 testing stage 2 early stage 2 levels there. So from a market breadth perspective on the internals, so don't necessarily rely on what you see on the chart always. One of the key things with stage analysis, and it's one of the things that most people miss, is that the market breadth is the most important thing. It's like you can look at index charts all day long, but they don't always tell you the correct picture. You need to see what's going on with the individual stocks, and you need to obviously look at multiple different measures and get the overall weight of evidence from that. Like Stan talks about it in chapter 8 of the book briefly. It's not a huge amount in there, but he was famous back in the 80s, 90s for having over 50 different metrics that he looked at, but he's talked more recently about it being more like 100 or so. Basically, he looks at a lot of different metrics to get all the technical indicators to see what's going on and get a broad scope of the stages. But the most proprietary one of those is just the amount of stocks that are in stage 1 and stage 2. So if you add those up together, and so the percentage of stocks above their various moving averages gives you a rough kind of guide towards that. If you've got majority of stocks are above their moving averages that are in stage 1 and stage 2, that you need to be above to be in stage 1 and stage 2, then you're obviously more likely to be in stage 1 or stage 2. It's very simple in that regard. So make sure you look at what's going on in the individual stocks and don't always focus on the indexes themselves, as the indexes are often a lagging indicator. Right, moving on, Nasdaq Composite testing the bottom of the range still at the moment. Did have a reversal move on Friday, slightly heavier volume, but obviously still underneath the 50-day moving average, still underneath the 21 EMA there. Long way to that 200-day moving average still. So dramatically underperforming the S&P 500. Still needs a 10+% move just to get up to its 200-day moving average. Lots and lots of overhead resistance back at the top of the range and from the prior stage 3 range. So Nasdaq is definitely a major lag. Look at the Russell 2000, different to what we saw in the Nasdaq there. We're above the 21-day moving average, but underneath the 50-day and underneath the 200-day here, but very, very close there. Potentially could push back through them in the coming week. It does, as I've said previously, we've got this major zone of resistance across here that's been support, it's been resistance multiple times. So this is our key level, and this would be our stage 2 breakout level to watch for. So we get a strong move up and through this 190 zone here. We potentially could move back into stage 2 in the Russell 2000. So look at that on the weekly, make it a little bit more clear. So this area here, we get a strong move up through here. Potentially we could start moving up into stage 2. The 30-week moving average would turn up and the 10-week would start to turn up there. So definitely one to keep an eye out for. If it does fail here low, as with obviously what we showed earlier, if it starts to fail, starts to roll back over here, could quickly move back down into stage 4, make a continuation breakdown to new lows. So no guarantees when you're in a stage 1 basing structure. Obviously could still go either way, but it is within reach of making a potential stage 2 breakout attempt, and it's been attempting to base obviously for the last 8 months or so. VIX tailing off a little bit on Friday there, gapped up earlier in the week on Tuesday after being closed for New Year's, so tailed off during the week. You see the price action didn't move much, but then obviously we're now getting down to lower levels. We want to see this continue down towards 20, continue lower. Obviously the lower this gets, the more positive it is in terms of on the long side for the stock market. If it starts to get back above that 200-day moving average, then obviously that would turn it back onto a risk-off type environment again from that indicator's perspective.